Welcome to the Time and Market Deep Dive. A quick reminder before we start, this is just for entertainment purposes, so please seek professional advice. Imagine standing knee-deep in a freezing California river back in 1849.
You've got a tin pan in your hands, you're freezing cold.
Exactly, shivering and surrounded by thousands of desperate people who all think they're going to pull a life-changing gold nugget out of the mud. But spoiler alert, almost all of them are going to go completely bankrupt.
Yeah, completely broke.
Right. But up on the hill overlooking the river, there is a merchant who is guaranteed to build a generational fortune because he is not mining at all. He is just the guy selling the shovels.
Ah, the classic picks and shovels play.
You know it. So today we are taking that strategy and applying it to the most intense technological gold rush of our generation, which is artificial intelligence.
And the central question we are answering for you today is whether you can simply buy the entire shovel store in a single transaction.
Right, just one click.
Exactly. We're doing a full analysis on the Global X Artificial Intelligence and Technology ETF.
Yeah.
The ticker symbol for that is AIQ.
And we have a massive stack of research today. We've got the official fund prospectuses, a really fascinating correlation study from S3 Partners, some structural analysis from the Motley Fool, and current market commentary.
It is a lot to unpack,
Mm-hmm.
but it's essential to see if this vehicle actually delivers on its branding.
Because let's face the reality of the market right now. Trying to pick the single winning AI software application feels like throwing darts blindfolded.
Oh, absolutely. It's incredibly risky.
You want to capture this staggering growth, but the single stock risk of betting your entire portfolio on one company is terrifying. So before we look under the hood of this ETF, we need to establish the baseline.
We had to look at the scoreboard first.
Right, exactly. How is AIQ actually performing? Does the reality match the extremely aggressive marketing?
Well, the baseline performance is undeniably strong. I mean, the current price is sitting around $69.44.
Yeah.
And if we look at the trailing 12-month period ending November 30, 2025, AIQ generated a return of 29.42%.
Wow. A 29% return in a single year is exceptional. But that number actually brings me to a major point of friction I saw in the S3 Partners research.
The correlation data.
Yeah, exactly. They analyzed the fund's trading patterns and found that AIQ is 97% correlated with the NASDAQ 100, and that is the index tracked by the standard QQQ ETF.
Right, the benchmark tech index.
So if this fund is tracking the broader tech market that closely, aren't investors just paying higher fees for a standard tech portfolio that just happens to have the letters AI printed on the prospectus?
A very fair question to ask.
It just feels incredibly reminiscent of the late 90s, when a pet food delivery company would add .com to their name and suddenly triple their valuation overnight.
Yeah, that is the exact psychological parallel the S3 Partners research draws, actually. During the dot-com era, branding was often a substitute for a real business model.
Cool.
And there's no denying that the AI branding on this ETF is working from a capital attraction standpoint. I mean, over a recent measured period, the shares outstanding for AIQ actually doubled.
Wait, doubled? Just like that?
Yes, doubled. Investors see the ticker, they get that fear of missing out, and they just flood the fund with capital.
Because they just want exposure to the magic word.
Exactly. But to address your point about it just being a disguised NASDAQ index,
Yeah.
the correlation is a deliberate structural choice. It's not just a marketing trick.
Okay, explain that. How is a 97% correlation not just the exact same fund?
Well, AIQ functions as a QQQ variant, but with a highly curated tilt toward artificial intelligence.
So I want to clarify that concept for the listener. When you say an AI tilt, you mean it is not a pure play vehicle, right?
Correct.
We aren't talking about a fund where every single holding derives 100% of its revenue exclusively from artificial intelligence.
No, because a pure play AI fund of this scale is practically impossible to construct right now without taking on absurd amounts of speculative risk.
Right, because who even is a massive pure play AI company that's publicly traded?
Exactly. The major players in AI, your Microsofts, your Googles, they are highly diversified conglomerates. They do a million other things.
Selling ads, cloud storage, whatever.
Yeah. So by maintaining that 97% correlation with the broader tech sector, AIQ strategically anchors the portfolio.
Oh, I see. It captures the upside of the AI infrastructure build-out, but uses the established giants to dampen the volatility.
Exactly. The upside is driven by unprecedented deal activity and capital expenditure, but the fund has a built-in shock absorber.
Okay, so the correlation is essentially a shock absorber. But that creates a fascinating mystery for me.
How so?
Well, if AIQ moves almost perfectly in tandem with the Nasdaq 100, you would expect their holdings to look identical, right?
You would think so, yes.
But when I opened up the portfolio data from our sources, the allocation was completely unexpected.
It really is surprising.
Because when anyone hears the phrase AI ETF, the immediate assumption is that NVIDIA is going to be the dominant #1 holding.
NVIDIA is the poster child for the AI boom.
Right. But in AIQ, NVIDIA is only the 12th largest position.
Yeah, it completely upends the conventional retail investor narrative. When the general public thinks of AI, they envision the consumer-facing chatbots, or they think of the single most famous American chip designer.
Which is NVIDIA.
Right. But AIQ utilizes what the prospectus formally designates as an unconstrained approach.
Okay, let's break down why that matters. Standard index funds, like the ones tracking the S&P 500 or the Nasdaq, they use market capitalization weighting,
Yes, they do.
meaning they automatically give the biggest slice of the pie to the companies that are already the most valuable today.
It is a backward-looking metric that essentially rewards past success.
Right, but this unconstrained strategy allows the fund managers to ignore those traditional rules.
Precisely. They do not limit themselves by traditional tech sector classifications, and more importantly, they are not limited by geography.
Ah, geography, that's the key.
Yeah, if you rely on a standard U.S. market cap weighted index, you are inherently blind to the global supply chain. AIQ actively bypasses that limitation.
So they are going overseas.
Heavily. If you look at the top weights in this fund, the dominant players aren't the household American software names. You have SK Hynix sitting at a 7.12% weight
Wow, #1 holding.
and Micron at 5.76%, alongside Advanced Micro Devices and Samsung.
Okay, so SK Hynix is a South Korean semiconductor company. The fact that they are the crown jewel of an American-listed AI fund really requires us to understand the physics of how artificial intelligence actually operates.
It really does. It's fascinating engineering.
Like, why is a South Korean memory manufacturer more heavily weighted here than NVIDIA?
It all comes down to a fundamental bottleneck in artificial intelligence.
Yeah.
See, training a large language model requires processing trillions of parameters.
Just massive, massive amounts of data.
Exactly. Now, the actual processors, the logic chips designed by companies like NVIDIA, they are incredibly fast.
Like, mind-bogglingly fast.
Right. But they are entirely useless if they cannot access the necessary data quickly enough.
Oh, so it's a traffic jam.
Precisely.
Hmm.
In a traditional computer architecture, memory chips are laid out flat on a motherboard next to the processor.
Okay, so they're side by side.
Yeah, and the data has to physically travel across that microscopic distance.
Yeah.
In the realm of AI, that tiny physical distance creates a catastrophic traffic jam.
So the processors are essentially starved for data because the pipeline delivering it just isn't wide enough.
Exactly, they're sitting there waiting. To solve this, the industry relies on high bandwidth memory, or HBM chips.
And that's where SK Hynix comes in.
Yes. Instead of laying the memory chips flat, companies like SK Hynix physically stack them on top of each other, almost like a microscopic high-rise
Like
building.
they stack them.
Yeah, and then they punch microscopic connections straight down through the entire stack. It's a technology called through-silicon vias.
That is wild. So instead of the data traveling horizontally across a board, it travels vertically, just fractions of a millimeter, moving almost instantly.
Exactly. They changed the physical geometry of the hardware to eliminate the traffic jam.
They built an elevator instead of a highway.
That's a great way to put it.
Mm-hmm.
And SK Hynix currently controls an estimated 61% of that highly specialized high-bandwidth memory market. They are the architects of that vertical highway.
Wow, this is such a critical takeaway for you listening. When you buy a share of AIQ, you are not placing a bet on which software company develops the smartest virtual assistant.
Not at all.
You are investing in the physical bedrock of the technology. You are acquiring a stake in the Taiwanese fabrication plants, the South Korean memory architects, and the global hardware ecosystem that allows artificial intelligence to exist in the physical world.
You are buying the most advanced shovels ever manufactured.
The best shovels. But identifying the best shovel makers is only half the equation, right?
Right, the other half is the price of admission.
Exactly, because after seeing a near 30% return over 12 months, we have to critically analyze the valuation multiples provided in the sources to determine if the market has already priced in all of this future success.
We do. Paying the wrong price for a fantastic company can still result in a terrible investment.
So true. Let's examine the price-to-earnings ratios. The sources show the trailing PE ratio, which measures the current stock price against the actual profits these companies generated over the last year. Well, it is pretty elevated.
Definitely elevated.
Depending on the exact window the analysts used, it is hovering between 25 and 31.
That is undeniably a premium valuation compared to historical market averages.
For sure.
However, the metric that institutional investors are heavily focused on is the forward PE.
Okay, and that ratio evaluates the current stock price against the earnings that analysts project these companies will generate over the next 12 months, right?
Exactly. And for AIQ, that forward PE drops dramatically, sitting just under 20.
I really want to dissect the mechanics of that drop because a multiple falling from 30 down to 20 implies a staggering vertical jump in expected profits.
It does.
The market is essentially pricing in perfection. If we are relying on a theoretical surge in future earnings to justify the price we are paying today, how are analysts actually calculating that forward number? Like, are they just guessing that AI will be profitable?
No, they aren't guessing. They are tracking the supply chain.
Tracking it how?
Well, the analysts calculate that forward PE by closely monitoring the capital expenditure budgets, the CapEx, of the major cloud providers.
Okay.
So when companies like Amazon, Meta, and Microsoft publicly commit to spending tens of billions of dollars on new data centers, analysts trace those specific purchase orders directly to the revenue projections of hardware suppliers like SK Hynix and Micron.
Oh, I get it. So the forward PE drops because the hardware companies have essentially already sold the inventory. They just haven't delivered it and booked the profit.
Exactly. It's already on the books as a signed order.
So the market is saying the current price is expensive based on yesterday's reality, but it is actually quite reasonable based on the contracts that are signed for tomorrow.
Yes, and the analyst community firmly believes those contracts will translate to stock performance. The aggregate sell-side consensus price target for AIQ sits at $74.61.
And given our current price of roughly $69.44, that represents an expected upside of about 7.4%.
Right. The professionals analyzing the balance sheets still see a runway for growth.
But, and this is a big but, that growth requires the hardware manufacturers to execute their production flawlessly.
Absolutely flawlessly, without any macroeconomic interruptions.
Which perfectly sets up the conversation about risk. If this ETF requires flawless execution to justify its valuation, what are the specific structural hazards you need to monitor?
There are several big ones.
Let's start with the cost of holding the fund, because fees are the silent anchor dragging down long-term returns.
They really are. The sources provide a direct comparison between AIQ and a traditional domestic tech fund, the State Street Tech ETF. The ticker symbol for that is XLK.
Okay, so how do they compare on fees?
Well, XLK operates with a remarkably low expense ratio of just 0.08%. AIQ, conversely, charges a management fee of 0.68%.
Wow, 0.68%. That's a jump.
Yeah. Over a 10 or 20-year investment horizon, that 60 basis point difference compounds into a substantial amount of capital.
You are paying a very significant premium, but based on our earlier discussion, you are paying that premium specifically for the unconstrained global curation.
That's the trade-off.
Because a standard tech ETF like XLK is bound by index rules that force it to heavily weight U.S. megacap software companies.
Exactly. AIQ charges 0.68% because its managers are actively structuring exposure to the Asian semiconductor markets that a purely domestic fund completely ignores.
But that active geographic exposure introduces a profound risk vector, right?
Yeah.
Geopolitics.
Oh, absolutely. Because AIQ relies so heavily on the physical infrastructure located in Taiwan and South Korea, the fund is acutely sensitive to international relations.
Right. Any escalation of tensions in the South China Sea or the Taiwan Strait does not just impact the theoretical future of AI, it physically halts the supply chain.
It stops everything. That is a distinct risk profile you do not assume when investing in a domestic software company.
So geopolitics is the big external threat. But there is also an internal threat baked into the very nature of what these companies manufacture.
The boom and bust cycle.
Exactly. We constantly hear that the semiconductor industry is highly cyclical. Can you walk us through the mechanism of why building computer chips inherently leads to boom and bust cycles in the stock market?
Sure. It is entirely driven by the time delay in manufacturing. Constructing a new semiconductor fabrication plant, commonly called a fab, is one of the most complex engineering projects on Earth.
You're massive, right?
Huge. It requires upwards of $20 billion and takes 3 to 5 years to complete. Companies authorize the construction of these fabs when demand is at its absolute peak and chip prices are soaring.
Right, everyone is screaming for more high bandwidth memory today, so you break ground on a new factory.
Exactly.
Uh,
But 3 or 4 years later, when your new factory finally comes online and starts printing millions of chips, the market environment has often shifted.
Oh, I see.
Either the initial demand has been satisfied, or your competitors also built new fabs at the exact same time. The industry swings from a state of severe shortage to a colossal oversupply practically overnight.
And then what happens?
The price of the hardware plummets, profit margins evaporate, and the stock prices of the manufacturers collapse.
Wow. And the macroeconomic environment dictates how painful that cycle is, doesn't it?
Very much so. High interest rates are particularly brutal for this sector.
Because when borrowing costs are high, financing a $20 billion fabrication plant becomes incredibly burdensome.
Yes. And high rates also reduce the present value of all those massive future earnings we discussed during the forward PE analysis.
Makes total sense. So, taking all of these variables into account, the valuations, the global exposure, the cyclical risks, we can synthesize the source data into three distinct future scenarios for your portfolio.
Yes, and notice the sources do not attempt to offer a single magical intrinsic value.
Because the variables are just too dynamic.
Exactly. Instead, they frame the potential outcomes based on probabilities.
Let's walk through those outcomes. What does the optimal environment look like? The bull case.
A bull case projects the EPF pushing into the $65 to $70 range and continuing upward. For this to materialize, the artificial intelligence boom must accelerate, and crucially, the hardware manufacturers must maintain their pricing power without overbuilding capacity.
Okay, so that is the scenario where the hyperscalers just keep aggressively buying every single high bandwidth memory chip that SK Hynix can physically produce.
Right, everything fires on all cylinders.
What happens if the growth is just normal?
Then we look at the base case. The base case sees the price stabilizing and grinding steadily in the $55 to $60 range.
Which means no massive upside surprises in technological capability, but the hardware companies successfully meet those aggressive forward earnings targets.
Yes, it is the price for perfection scenario actually playing out perfectly, just without any extra icing on the cake.
And then there is the scenario that keeps portfolio managers awake at night.
The bear case.
Yikes.
Yeah, the bear case envisions the ETF dropping down to the $40 to $42 range.
That's a steep drop. What triggers that?
It would be triggered by a combination of factors. An AI monetization failure, where software applications fail to generate enough consumer revenue to justify the infrastructure costs, combined with the classic semiconductor bust cycle.
Where new fabrication plants flood the market with excess chips.
Exactly. Too many chips, not enough paying customers.
So if you are currently holding AIQ, or you are evaluating it for your portfolio, you need tangible metrics to track. You can't just watch the daily stock price.
No, the stock price is a lagging indicator in many ways.
Right. So what are the specific dials on the macroeconomic dashboard you should be monitoring to see which of those three scenarios is actually becoming reality?
According to the sources, there are two paramount indicators to watch. First, rigorously track the aggregate capital expenditures of big tech.
The CapEx.
Yes. You need to see total CapEx spending remain above the $500 billion threshold.
Okay, 500 billion, that's the magic number.
If companies like Amazon, Google, and Microsoft announce during their quarterly earnings that they are scaling back the construction of new data centers, that is a severe red flag for the entire hardware supply chain.
And the second indicator?
Closely monitor the Federal Reserve's interest rate policy. Rate cuts will serve as a powerful tailwind, cheapening the cost of building those essential fabrication plants.
And sustained high rates?
They will act as a constant gravitational pull on those valuations we talked about.
Okay, let's synthesize everything we've unpacked today. AIQ offers a compelling, globally diversified approach to investing in the artificial intelligence revolution.
It really does. It's a unique tool.
It purposefully avoids the danger of betting your entire portfolio on a single stock like NVIDIA. Instead, it utilizes an unconstrained strategy to cross geographic borders, actively targeting the vital hardware and infrastructure companies in South Korea and Taiwan that physically make AI possible.
One's building the highway.
Exactly. However, that specialized global curation requires you to pay a significantly higher management fee than standard tech ETFs. Furthermore, the current valuation means you are paying a premium today for staggering earnings growth that absolutely must materialize tomorrow.
It is an incredibly sophisticated vehicle designed for a highly volatile sector. But I want to leave you with one final conceptual question to consider as you evaluate this space.
A little food for thought.
Exactly. Is a question that challenges the long-term viability of the entire picks and shovel strategy.
Okay, let's hear it.
If artificial intelligence truly achieves its ultimate goal, like if it becomes core infrastructure for the entire global economy, as ubiquitous and invisible as electricity or the internet itself,
Right, it's just everywhere.
will these hardware and chip providers be able to maintain their premium profit margins? Or will their miraculous, highly specialized hardware eventually be aggressively commoditized by the market, transforming today's high-flying tech darlings into tomorrow's slow-growth utility companies?